this next episode of Governance Dialogues. My name is Elisa Cole, and I'm the Managing Director of Governance Center. And as always, I'll be a host today. For this episode that we gave a slightly controversial title, Can Your ESG Data Seal the Deal with Investors? And in fact, ESG data and the quality of this data is the topic of the day. If in the financial press, we hear constantly discussions around ESG reporting, sustainability reporting. And in fact, it is an important question for many companies. If we look at just the climate risk, which is only one part of ESG risk, climate change is a materially important risk for about 65% of the listed companies worldwide. So these are really important issues to discuss, and issues that are being discussed currently from Europe to the US to emerging markets where governance is very active. And I couldn't think of a better person to invite to discuss the quality and the data that is being put out by listed companies on their sustainability, governance, and social performance than William Cox, who's a seasoned expert in this subject. And he's joining us today. He's founded a very interesting company called Yield Drive, which is a pioneering fintech company looking at specifically quantifying financial impact of ESG in listed companies. And Yield Drive does so through a cutting edge AI technology, which William will be talking about. And I'm delighted to host him here today on our program to discuss these issues. Welcome to the program.
Thank you very much, Alisa, and thank you for inviting me and for this opportunity to exchange views with you. And yes, indeed, you know, this ESG is a huge market, 50 trillion US dollars invested currently according to ESG. So I think it's a very relevant topic.
It is indeed, in terms of both spending and the cost to companies, and this is something you've pointed out in your work. I mean, if you look at global landscape today, just to perhaps to set the stage for our audiences for this discussion, we have about 40 of the 44,000 or so listed companies, about 10,000, so a quarter, roughly speaking, publish some sort of ESG data. But there are questions about data comparability, which we know, and we've discussed actually on one of other episode on this program with a very well-known expert that you probably know, Robert Eccles. We also address data issues of data scarcity, which is important, I think, in some emerging markets where sustainability data is only becoming or sort of starting to emerge, and we face the challenge with some of the clients we work with. And also, there's a question of data verification or the quality of the data. You know, we know that in about 2/3 of the company's sustainability data is verified by an external party, usually an external auditor. So there are a number of host of questions around how this data comes around and the cost of this data, because as you point out in your work, an average company spends around $700,000 in getting a 200 or 300 page sustainability report. So of course, the question that begs itself is this valuable to investors? And that's something I'm hoping to discuss with you today for the benefit of our audience. And I think the first question that pops to mind is on fragmentation of ESG reporting frameworks and the impact that you think that might be having or not on the quality of data that's being put out there by listed companies.
Well, let me start by just quoting a big asset manager. I'm not going to divulge their name right now, but it's a very typical reaction to this kind of fragmentation of data and the ESG data problem in general. He said, we pay several $100,000 for ESG data every year. And we also review all of the ESG reports of the companies we're invested in, and most are listed. We get all this pile of data on our desk, and then our work actually starts. In other words, these frameworks don't help to put financial numbers about risk return to the ESG investments, which all of these companies engage in. And just to give you an idea of what companies actually spend on, not only on the data, but on the ESG investments, ExxonMobil in its SEC filing cited spending $5.4 billion US on ESG, but half is OpEx. In other words, you would think, oh, that includes equipment, and half is for equipment and half is for operating expenses related to ESG, reporting, compliance, systems, internal systems, the whole thing. That's a ton of money to reduce and control the risk. And what investors don't have on the other side is like an income statement, like a valuation. What is the financial impact of this? And that's where we come in. That's kind of our neck of the woods, our specialization. But that's one of the basic problems. The other is the fact that there's, as you mentioned, too much fragmentation. In other words, so point one is the data is not really financially revealing. Point two is there are too many frameworks. So regulators have come in and imposed their own frameworks. But even there's great differences. The EU is more about climate risk, climate change, that kind of thing, kind of weak on governance. Brazil is going toward IFRS S1 and S2, which are single materiality frameworks. In other words, they quantify the financial impacts of ESG on the company's results. Hong Kong, Singapore are also requiring and going to require S1 and S2. And so IFRS, being an accounting firm, I think has the best chance of providing a framework or requiring a framework which investors can use to see whether ESG is making a financial difference or not.
In fact, you sort of alluded to the next question that I was going to ask around regional differences, because we do work with clients and
right.
in different parts of the world. Some countries don't even have really a clear adherence to a regulatory framework. So it happens that sustainability department,
right.
recently established department tries to collect through some sort of questionnaires, data, ad hoc, frankly speaking, from different departments and constitute in a sustainability report. And then, of course, the comparability of that, as you point out, with Latin America, with Europe, is pretty non-existent, if I hear you correctly.
Yeah, that's the problem. That basically we have a lot of frameworks which require box checking to say, okay, I have this, I've done this, my greenhouse gases are so much, it's less per capita or something like this. That's all fine. But in the end, investors want to know, is ESG, which is a major investment among big companies, and it is also the topic of investment funds, is ESG making a difference? Is it making the company more resilient to shocks? Is it generating operating impacts or impacting the value of the company?
Exactly, and I think that's what I would like to also come to is risk, and what does ESG actually contribute to mitigating risks? Because ultimately we're talking about a risk mitigation mechanism and a value add mechanism for risk mitigation. So I suppose the question that I would like to ask very pragmatically is around strategies that listed companies can employ to ensure that their reports actually reflect real sustainability efforts, and metrics that company can, reasonably employ beyond what you alluded to, the obvious ones, greenhouse gas emissions and whatnot, to communicate performance metrics that resonate with the investor community.
We recommend, first of all, companies have to comply with regulatory frameworks. So do that first, do what you have to, and then look to what investors may want to see. So what would investors want to see besides regulatory compliance? Report financials as well as you can. Start calculating this. Asset managers are doing that. So what we would recommend is an ESG report, not with endless frameworks, but with one framework according to regulations, and add to that on the executive page, or at some point in the reporting, a chapter on the financial impacts or approximate financial impacts on risk return of the ESG ventures, more or less specific. And IFRS S1 and S2 is probably the best voluntary framework right now that I know of to do this. So, that framework would also be a way of reporting these financials. And, you have to remember that with 50 trillion, that's about a little over a third of all the investments worldwide. So ESG is a theme. With this much money being invested, but no real financial returns. In history, this is unparalleled. Investors have always had themes, investment themes, and we're able to show what are the returns, the impact on risk return of these investments. And we've come this far without having that. So it's an amazingly shocking situation, actually.
It's interesting. We've been observing it in our work, and I wonder what you think about this whole conversation on greenwashing. Obviously, so if there is no financial return, as you say, we're kind of sitting on a balloon in a way that we know, or I mean, unless everyone except for the right-wing American parties generally value of disclosure on these topics. And I think US is frankly the only country where this debate is really ongoing in a more philosophical terms, not in terms of the how, but in terms of the if. But if we assume that we agree on the value of this disclosure, what is your view on greenwashing and the kind of the risks that this presents in light of this variability of reporting frameworks, the data that's collected? What is your experience and thoughts on that?
Well, greenwashing is related to the number of frameworks and reporting frameworks. In other words, you have so many reporting frameworks with so much data that it actually furthers greenwashing. In other words, I can cover up actual weaknesses by throwing a lot of fluff out there, by throwing a lot of data, creating a lot of noise. And one example you probably know of is Signa, the Austrian and now bankrupt real estate company. And before they went offline and entered into bankruptcy negotiations, they still had their ESG reports online, which were very extensive. In fact, most of their website was about ESG. What they did internally, a lot of pictures, you could tell they spent a lot of money on design and text, and there were numbers, no financial numbers, by the way, no annual report, no quarterly report. And banks like Bank Bear, in this case, fell for that. They invested $650 million and lost it. So in other words, if you have a lot of data which are not to the point, in which we do have in ESG, then there's always an opportunity to sort of create noise and sidestep the issues. If we have a tighter framework focused on financials, the financial impacts of ESG, then it's much more difficult to greenwash. It's much more difficult to conceal the weaknesses in the company's management systems. At YieldDrive, we have a greenwashing ratio, which, although not indicating anything final, indeed would be able to identify red flag cases where there's a lot of data, but the performance, which we've calculated, is low. Doesn't mean that a company like that, with that kind of ratio, would necessarily be engaged in greenwashing, but it would be an indicator for investors to look deeper.
Interesting. In fact, that what you were saying, and I entirely agree, pinpoints the fact that both are risks. Non-disclosure, a risk, and
Right.
we know, investors are fighting this battle. We work also with many investor associations that are looking for, and I've interviewed some on this program, shareholder commons, who are trying to,
Right.
incessantly, support investor lawsuits for better disclosure. But what
Yes.
also interesting, because there is another side of this coin, in a sense that better disclosure could actually be, in your latest example with this Austrian company, a risk in and of itself, because it is luring investors in a potentially dangerous way of thinking. But you also alluded to in the last comments on the work of your company to ensure the accuracy and reliability of this data, and I know that you're using AI, which is kind of another different and interesting conversation. So I would like to hear, perhaps for our audience, I'm sure they're asking themselves how your company is actually positioned to play this verification mechanism without you being an external auditor coming in and, let's say, taking the company's data and working with it directly. So would you mind to walk us through that thought process?
Happily. Our motto is ESG in dollars and cents. Okay, it kind of explains where we're coming from. But there are several components necessary to achieve this. And one, as you mentioned, is our AI. And there's a little story behind this. When we were developing our technology over the last 3 years, we were looking for a provider of ESG data, of reliable ESG data, of meaningful ESG data. We finally agreed on one, which cost us a lot of money. And we bought data for 4,400 companies going back 10 years. And when we looked at the data, audited the data, only partially, for example, if we take Apple Inc., one of the largest companies in terms of market cap, there were reports in there about the fruit or about an apple fest in Vermont. And all of these data drawn from a multitude of sources would have distorted our later calculations. And so what we had to do to achieve more accuracy was to say, okay, guys, you have to do all this over again, and we're going to define the sources. Redefine. They said, oh, we have 10,000 sources or God knows how many. And, we're covering the whole market. The thing is, most of these sources were not credible. So we reduced it to about 160 sources, like the FT, the journal, sources which everyone knows, also research institutions in ESG Today, and specific sector magazines. Improved and developed our own AI, and our own AI then scans also regulatory filings, extracts from them from news, assesses their sentiment and relevance to each indicator, to about 130 different indicators and companies, and then produces for each piece of news a profile. So it's rated, it's scored, each piece of news goes through this process, and the process is complex. There are a lot of phases and cleaners and what have you before the data comes out and is processed. So as you know, if you have good data going in, the chance of meaningful evaluation at the end improves. So we have all the pile of data on all these companies, and it can also be used for specific unlisted companies as well, which is a very large market. Okay, right now we have listed, but all we have to do is basically input or present the reports, and scan the news, and you have the same kind of data on unlisted companies. So then come the financial calculations, which are various, but I'll just say they were tested over a period of about 15 years when we had two indexes with Euromoney Media in Brazil and Hong Kong. And in those indexes, we used and developed, perfected the algorithms which we now use. And the Brazilian index, which was under the name of my previous company, outperformed the Ibovespa benchmark by up to 70% and never went below 50. Hong Kong was not that great. It was 18 to 22%. I know asset managers may be satisfied with that too. But the key was that we assessed each company's ESG, financial ESG performance, and weighted the company in the index according to its financial ESG performance. And this played out to higher equity values. So, these are basically the components, the AI plus our algorithms.
That is really interesting.
Yeah.
Actually, I've read obviously about the model, but I wasn't aware of how you actually, like, this process that you refer to of assessing and verifying news on indicators. And I'll come back to that, because it's also interesting vis-a-vis, for example, how other entities that collect and verify data do that. So, for example, let me ask you, ISS, or the likes of ISS, they also collect and report.
Right.
How different do you think your model is to theirs, and what are the points of similarity?
Right. I think one differential, it's not the only one, but one differential is our choice of indicators. I've been in this field a long time. I don't know how many years, 20, 25. And we use indicators that are both accepted in SASB and other frameworks, but are known to impact financial results. And they may go beyond, in part, beyond the usual governance or social or environmental frameworks. Just a couple of examples. For example, community relations. If I'm an oil company or an industrial company, I need good community relations if I'm going to get permits to build supply chains or new production facilities, refineries, that kind of thing. So there's a definite impact of that on financials, or under good management, and we put good management under governance, not just the OECD standards. If I want to see whether the company has a digital or digitalization policy, and I don't only mean, for cybersecurity, that's a separate area, but if I want to, there's studies which show that without putting IoT types of systems on your, legacy production equipment, you're not going to be able to meet the greenhouse gas and climate standards, for example, of Europe, because there's too much inefficiency. And if you digitalize that, then you're going to be more efficient. There'll be less waste. There'll be less emissions. The whole production process will become also more efficient. And that's a direct, financial impact as well, or training, technical training, all kinds of training. We have seen before Yield Drive to be the most profitable investment in terms of ROI, which a company can engage in, innovation processes. So we look at these indicators. So we start with the indicators. That's a differential. It's at the very beginning. And then the AI probably is a bit more sophisticated than what's on the market, because we have more phases in processing, controlling, categorizing the information that goes in. If I look at reports, for example, SEC regulatory reports, the information is always neutral. But the news sort of comes in, the news may be more critical or more positive or rate the results of these processes. So I have news plus regulatory reports.
And it's interesting, this concept of triangulation and trying to, let's say,
Yeah.
out and weed out what is relevant and what is not. And it makes me think, because you also mentioned the OECD, and I used to, as you know, lead OECD's work in governance for about a decade also, and working specifically in the Middle East and other areas.
Yes.
My former head of department at the OECD used to always laugh and say, garbage in, garbage out. So referring to the quality of data. And this is the critical thing, or the critical aspect that you're highlighting, I think, with your model and referring to sectors also. And we worked at the time, for example, on valuation or standards for valuations of intangible assets. And it was also quite sector specific. So, what you care about community performance for oil and gas companies is not the same thing as for a shoe manufacturer. And all of these are sort of echo actually with other governance and accounting initiatives, as I mentioned, on intangible assets and other pieces. And it leads me to think, or to dive a little bit further in this conversation, and perhaps ask you if you can walk us through a specific example of your work, if you could share perhaps on your screen how this system or the sophisticated framework that you've described, or the AI kind of triangulating different news, how it actually works in practice. If you could give us a glimpse, please.
Sure. Let me share my screen here. This is an example of one of the 4,400 companies we currently have in our database. It's a Canadian listed company, Thomson Reuters. I think we all know it as a good company. And I'd like to focus on, of all the data here, I'd like to focus on one particular key data point, which probably is the result of 20 to 25 calculation steps. We can't do it without AI. We ingest financial information, we ingest all of the ESG process data, and that is a valuation type of data, the yield drive ESG contribution to the fair value of a company. So on the left, and I hope you can see my cursor, there's a golden bar, which is the consensus price of the among analysts of the fair value of this company in a year. So they say the share price, the fair value is $137.92. In this case, we've calculated that ESG has not been sufficiently priced into this. Okay, and to the tune of $16.58, which means that ESG, the ESG adjusted fair value is higher, to the tune of $154.50. Now, let me qualify that this may be a negative number. In the case of greenwashing companies, it can be that ESG is not just like a cost without result, but it can have a negative impact on the risk return, as it did with Cigna. And if I delve into the fair value a little more and explain what goes into this, it's based on an adjustment of the ESG cost of equity. So we have the actual cost of equity of Thomson Reuters at 6.27%. We've calculated that ESG has a risk mitigating effect on the cost of equity to the tune of 12.02%, bringing it down to 5.6%, the cost of equity. This is a major impact. This is a major impact. And Elisa, as you've alluded to, investors are looking for risk return of ESG. With this number alone, and without all the other numbers we have, with this number alone, they can discount cash flows according to an ESG value. They can split up the sources with our data exactly how many basis points are coming from, say, the G area, the S area, the E area, specifically what areas are strong, which areas in the company are weak. And this was not an easy birth, more or less, or development. It took many years to develop this. It does use existing frameworks, financial frameworks, the capital asset pricing model. But we adjust the beta with our proprietary algorithm, which I elucidate has been proven in the field over a number of years and published. So for investors, this piece of data alone is sufficient for them to see, okay, ESG is a good deal here or not.
It's actually, I find it fascinating, looking at this model. And I think the question, kind of the big picture question that begs itself looking at this particular example is, in your database, you mentioned you cover, I think, about over 4,000 companies, if I'm not mistaken. How many what would be the percentage in rough terms where ESG value can still be unlocked versus those where, we would say potentially there's some sort of greenwashing going on?
I don't have exact figures on this. Let me just make an estimate off the seat of my pants on this one. Okay, just to qualify, we have a lot of filters, but in that term, I would say that the proportion of companies where ESG is not sufficiently valued in the stock price is 20 or 30%. No more than that right now. Probably in the neutral field, another 50% or 40%, and the rest would be where ESG is actually not contributing at all, or contributing in a negative manner that is actually increasing the risk and depressing the value of the company. So this means for investors that just because a company is filing a lot of data, is reporting a lot without knowing or having some calculation on the financial impacts, on the risk return, this in fact could be a bad investment. So, it's then better to leave ESG out of your deliberations or decision-making process entirely than to use ESG in the wrong way.
It's I think, even for me, and I've been in this field for, 15, 20 years also, I think it's a fascinating model, and it's actually a really, really fascinating discussion. It's been with you, and I'm sure many of our audience sort of would like to go and have a look at your data, and they can probably do so through your website and the tools that you provide. And I think perhaps for another conversation we'll be having with you, maybe in future episodes of this program, we can talk about AI. And we've been writing that a lot about governance of AI and what AI can bring to the decision-making process, for example, in boards. But here we have another sort of a whole other dimension of what AI can bring to this whole ESG dialogue. Can it distill some of the noise and help us arrive at more meaningful information, even without, let's say, fundamentally reconciling the regulatory frameworks, which is something, another discussion, I think, altogether that we could have. But I'd like to thank you so much for sharing your time so generously, and for sharing the model that you've built, which I find personally very impressive. And hopefully on our next episode, we'll be able to talk about AI and the ESG space.
Would love to, and AI is a big part not only of our model, but it's going to have an increasing impact in the ESG and investing field in the future. So I'd certainly welcome talking about that more, and maybe inviting my colleague who knows more about the technology. Okay. Well, thank you so much for your time, and for our audience, thank you for joining this for what I thought was what I think is a fascinating conversation. We'll put some links in the video and also in the description of this program to the Yield Drive model.
that you can explore at your convenience. And of course, in our thought leadership, you can also have a glimpse at in discussions on ESG reporting and how it is evolving. So thank you for joining us today, and we look forward to having you on future episodes of Governance Dialogues.
Many thanks, Alisa, for the interesting conversation opportunity to speak with you and your audience.